Get into this video, guys. Today I want to talk about a question I have been receiving a lot. How can I recover from a bad stock move? And so I'm going to show you guys a strategy that we can implement to help us recover from our stock losses a lot quicker with no additional risk to us. Okay, and so the goal here will be to help investors who have suffered a substantial loss in a stock position. And we're talking a 10 to 50% loss. If it's more than 50%, it might take a little bit longer to recover with this strategy. Now, here's the thing, right? When you buy a stock and you've suffered a substantial loss, most of the time people think they only have three main options. You can either sell and cut your losses, you can hold and hope that the stock will recover, which may take a long time, or you can double down, average down, keep buying as it dips. But as we've seen recently, things keep dipping and dipping and dipping, and that strategy hasn't really been working out as well. Now, fortunately for us, there is a fourth strategy, and that's what we're going to be showing you guys here today. This strategy will help us reduce our break-even point without taking additional risk. It will help us recover from our losses. Now, in order to utilize this strategy, you will need to have at least 100 shares of a stock because this will require us to sell some options here. So you do need to have at least 100 shares of a stock to implement this strategy. Now, with that being said, I'm going to go over to NEO stock because I do have 210 shares of NEO. So I can utilize this strategy on NEO if I wanted to. So I'm going to go over to the options for NEO stock. Now, let's just pretend that I bought 100 shares of NEO at $46 a share. Now NEO's trading at $36, meaning that I would be down $1,000 or so. So here's what we're going to do to implement this strategy. First thing we would do is we would buy one at the money call option, right? And so we're already at buy calls, and we want one at the money option. At the money basically means strike price is the same as the share price. And so the closest strike to the share price is this $36 strike. So let's actually go to May 14th for this. So I would do 36. I would buy this at the money call option. That's the first thing that we need to do. Now what we're going to do is we're going to follow this by selling two out of the money call options. So we would go over to sell. We're still on calls, and we want these to be out of the money. Out of the money basically means the strike price is above the share price here. Now, more specifically, what we're trying to look for is that the share price or the money that we're receiving from selling these two call options ends up being as close to the cost of the call that we're buying. So for buying this, it's going to cost about $160. So for selling these two options, we want something that's very close to that range. So I would choose, for example, in this scenario, the $38 strike, because you can see we're going to receive about 74 cents per share. Remember, each contract controls 100 shares. So I would receive about $74. But again, we're selling two out of the money call options here. And as you can see, this is a call debit spread, and we'll come back to it here in a second. So we can go to this drop down and click on custom, and we would change this to be 2. Okay, and so this would be 2 here. If it ever moves, there we go, 2. And so we're only paying about $9 or so. So as you can see, it's going to be almost cost free to enter this strategy here. By the way, this is called a stock repair strategy. That's really what this strategy is called, the stock repair strategy. Now, as you guys saw, right, when we only had one here, this is a call debit spread, right? And then we're selling 2. So as you can see, if you haven't noticed, this is basically a combination of a covered call and a call debit spread. And the reason I'm mentioning this is because that's kind of how I'm going to be presenting this, because the options profit calculator doesn't have a stock repair strategy tool that we can use. So we can kind of just visualize this as entering a covered call and entering a call debit spread. And so what I'm going to do here is I'm going to go first to this right here. So this is a nice example of what this would look like, and then we'll actually take a look in the options profit calculator at this exact example and talk about how this works and why it works that way. So as you can see, let's suppose that there's a trader who bought 100 shares of some sort of stock, doesn't matter what stock it is, at $50 a share in May. But it has since declined to $40 a month later, right? This individual would have a paper loss of $1,000, right? Now the trader decides to employ this stock repair strategy. They're doing this by implementing a 2-to-1 ratio call spread. So they're buying an at-the-money call option. So they buy a July 40 call because the price of the stock is currently at 40, so at the money would be 40 for $200, and selling two July 45th calls for $100 each. And again, the reason they're doing that is because they're going to receive $200 here and they're paying $200 here, which would end up, canceling each other out. Again, they're taking no additional risk. So the net debit credit taken to enter the spread is 0. So let's actually visually see this here, guys. And again, I'm going to do this by combining these separating these into a covered call and a call debit spread, because that's basically what is happening here. So here's the covered call firstly. So again, we're pretending that we purchased 100 shares at $50 a share, but now the stock is currently at $40 a share. So what we're doing, again, we're buying one at the money call and we're selling two out of the money calls. So let's sell one of those out of the money calls here. Again, this is going to be the covered call. So we would sell one call option. And again, we chose the 45 strike from that example we just read. I just chose the next week's expiration. And again, that's going to give us about $100 in credit. And then I entered the stock price range from 40 to 50. I calculated here. So as you can see, our entry cost is $100. That's a credit. We're receiving $100 for selling this call. Max risk, of course, is $4,900 if the stock drops to 0. And as you can see, our max return is still negative, right? Our max return here is negative $400. And that makes sense because, again, remember, we bought the stock at 50. We're selling a covered call at 45. If the share price goes above 45, we're going to be forced to sell our 100 shares at $45 a share. Since we bought each share at 50, but we're selling at 45, for 100 shares, that would be a $500 loss. But then remember, we're getting a credit of $100. So overall, we'd still end up losing $400 from this trade right here, this covered call trade. But now we're also entering a call debit spread, right? So we can go to the call debit spread over here. So same thing. We're saying stock price is 40 right now. We're going to buy an at the money call option. So at the money was the 40 strike, same expiration date. From the example, this would cost us $200. And then we wrote our other out of the money call option. Again, strike price the same of 45. We said that that was going to pay us a credit of $100. And of course, same expiration. So this again is a call debit spread. And if we take a look here, our entry cost on this one is $100. We're paying $100 to enter this call debit spread. But now, as you can see, our max return is $400. And again, that would happen at the $45 on expiration date. So as you can see, it's very simple now to kind of see what's happening here. You're selling a covered call, you're receiving $100, and then you're using that $100 you're receiving from the covered call to enter a call debit spread, because that's how much this is costing us to enter. And then you're hoping that this call debit spread turns your trade into more money, right? Because this $100 can potentially turn into $500 and you can make another return of $400. Also, of course, keep in mind that when we're entering this trade, we're getting a credit of $100. In this trade, we're paying a debit of $100. So that ends up canceling out. So again, there's no additional risk to the trader here since that cancels out, but there is potential upside, right? And so as you can see again over here, our max return is minus $400, but over here our max return is positive $400, which means you would break even at $45. If the stock hit $45 on expiration, you would break even. If you did not enter this trade, right, in order for you to break even, your stock would have to go back up to $50 a share. right? So as you can see, this is a really nice strategy because now you don't have to wait for the stock to go back to $50 to break even. It just needs to go back to $45 a share to break even. So again, this is a stock repair strategy. I did split it into a covered call and a call debit spread. I think it makes a little more sense to look at it that way. And again, the option profit calculator doesn't have a tool for that, but that is the call or the stock repair strategy, guys. Now, of course, the other thing to keep in mind is risk of assignment. You are selling a call here. So again, if the price of the stock does go above the strike price, you will be forced to sell your 100 shares of the stock there. So anyways, if you have any questions, feel free to leave them in the comments section below. Check out the Discord link to it in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.